Welcome and thank you for your time. My name is John Wright and I'm here to help you become better investors. This webinar is designed to be interactive, just like if we were sitting in the same room. I'm here to answer your questions and engage with you, so please don't hesitate to participate. There will be several polls and I'd encourage you to contribute. There's also a chat box in the upper right-hand corner of your screen. Feel free to submit questions at any point, and I'll do my best to answer. There will be a Q&A at the end, but if I don't get to your response, I will email you afterwards. You should know that only I can see your questions. The other attendees won't be able to see, so feel free to comment, put anything down. There's no such thing as an embarrassing question. This webinar is about group education. And I love doing group education. I also like doing one-on-one. So if you find the content interesting and would like to book some time with me, there will be several opportunities to do so. I encourage you to take advantage of that. And I'll also provide you a bonus or two. Actually, I've got two different bonuses in mind for encouraging booking those one-on-one meetings. Finally, before starting with the actual webinar, to maximize your value, the value you get out of this webinar, I would encourage you to do a couple of things. One, focus on the topic. Two, don't bury me under a back tab. I have several graphs which are a little bit dense in nature. There's a lot of information on there, and I have not mastered the art of simple graphs yet. So I apologize for that, but I would ask you to keep that tab front and center so that you can stay with me on the charts that I'll be showing. So forgive, focus, and ask questions. Comments are always welcome. Appreciate it. Now, in terms of introductions, so again, my name is John Wright. My background, I am a former chemical engineer, which means that I am analytical in nature. I was privileged to go to Stanford Business School and pay lots of tuition, which leads me into McKinsey Consulting to pay off that tuition. But most of my career has been spent with senior management at Fortune 500 companies. You can see some of the companies listed there. But I've had broad experience across many different industries. I left that life behind to be an RIA. That's an investment advisor based in Tennessee. And you may be familiar with the term fiduciary. So I am a fiduciary for my clients. I am legally obligated and want to put their desires first. And I'm regularly audited by the state of Tennessee to make sure I'm doing that. I'm also a CFA, Chartered Financial Analyst, which means I'm good at taking expensive tests. And I've been featured in various media, television, podcasts, radio. If you'd like to listen to some of those, Google John Wright Stellar Assets, the easiest way to find them. On a personal level, I like to drive fast, ideally without getting tickets. I like to travel. And when I'm not spending time with my family, my 3 kids, my 2 dogs, and my 1 wife from Brazil, I like to invest money on behalf of clients. Personally, so you see a bunch of fun pictures I put on here. Hopefully fun. They were fun when we were taking them. My preference is this one here in the Galapagos Islands inside of a giant tortoise shell, but you might find this adorable little pain in the neck over here to be a better picture. Her name is Mala, which means bad dog, and she earns it on a regular basis. But fire up the chat box. Tell me what you like, what you don't like. Tell me where you're from. Love to get to know you better. Relevant to this discussion, I am also an author, having written a book with a hopefully not too offensive title, You Know Nothing About Picking Stocks, and that's okay. Most people, most professionals, if we're being honest with each other, don't have a clue on how to pick stocks. So don't feel bad. The professionals are just as bad as you are. We'll talk more about that later. This book started me down the path of asset management. I was, when I wrote it, I was working in the real world. And I looked back over my investment returns over the prior 10 years. I earned 30% a year for 10 years. And I started to say, well, that's interesting. I should figure out what I'm doing right. In dollar terms, I took a very small retirement account, $31,000, and I grew it into over $400,000 in that time period. So I sat back and I had to ask myself, what am I doing right, and try to document it. I also had to overcome my natural biases because I was raised in the Northeast. And in the Northeast, you are naturally skeptical of everyone and everything. And so I was skeptical that anyone could beat the market. And so writing this book was an exercise for myself to convince myself. It was a self-evaluation to prove to myself that I could beat the market and to understand how I was doing that. I came up with these 10 principles that I used to generate strong results. Each principle is a chapter in my book and was put down on paper partly to solidify my own thinking. The book was written for do-it-yourself investors, but it's also helpful for prospective clients to understand how I think about money, how I think about making investments. These are not earth-shattering principles, as one of my Amazon reviewers was careful to point out, but they are hard to implement because at the end of the day, investors are human. And as humans, we lack discipline. We lack the right temperament to be effective investors. So it's easy to say and hard to do for some of these things. So after having written the book, I now believe, and partly because of replicating these results with clients, I now believe that beating the market can be done. And we're going to spend some time today going through the principles needed to do that. My goal in this webinar is to educate you broadly on these principles, but ultimately I would love to help you apply these principles to your particular circumstances. So I'm more than happy to meet you one-on-one, and I'm going to encourage, I mentioned earlier that I had some incentives to book these one-on-one meetings. And the first incentive I have is a free copy of my book to the first 10 participants to book a one-on-one appointment. If you do not get in on as one of the first 10, then I would also welcome you buying my book on Amazon and leaving a positive review, hopefully a better one than, there's nothing new here. These are old principles. So I'd appreciate it either way. We're going to talk about the 10 principles, but before we do, we need to talk about stocks generally. Stocks are the place to be for long-term wealth creation, and there should be no doubt in anyone's mind. This is a graph looking over 200 years of history, and if we had started with $1 in each of these major asset classes, what would that dollar be worth today after adjusting for inflation? And you can see clearly stocks were the place to be, will be the place to be in the future, in my opinion. $1 200 years ago has turned into close to $1 million today. Bonds and bills flat for the last 100 years. Gold is flat as it should be. Gold is the ultimate inflation hedge in my mind. And so $1 200 years ago is worth in the range of $1 today. Now, I would say that if you want to invest in gold like I do, which is through gold mining stocks, right? So get that inflation hedge plus the benefit of being in the stock market. And then finally, the place you absolutely should never be, or should minimize, is in cash. So $1 in cash 200 years ago is now worth 5 cents. So that's your choice, $1 million or 5 cents. Doesn't seem like much of a choice. Time for a poll. What percent of your assets are in stocks? This doesn't have to be exact, just looking for a rough number. And I want you to think about what percent of your assets should be in stocks. Knowing how good stocks are as an asset class, this could be a very short webinar. I would give you a tiny piece of advice. I'd say buy a Vanguard fund reflecting the overall market. Your management fees will be low. You're going to do great in the long term. That's never a bad option. Of course, there is risk in the market, especially now. By some metrics, we are at the extreme end of all-time risk, of all-time high valuations. And if the market goes down hard, you will go down just as hard with this strategy. Plus, you have no upside. You're not going to beat the market investing in an index fund. But you'll still do great in the long run. I believe you can do even better than that. I think we can do better than that. My goal for you, I've got 2 goals for you. One, to outperform the market, which I mentioned I believe is possible. And 2, to at the same time leave some downside protection in place so that if those high valuations actually catch up with the market, you'll have some protection in place. This is a journey. It's a journey. It's a journey with you having your cake and eating it too, but it's a journey. And so that leads me into quoting one of my favorite books, The Greatest Salesman in the World by Og Mandino. And I think this quote is relevant because we're going to talk about these 10 principles of success. And Og says, I will commence my journey unencumbered with either the weight of unnecessary knowledge or the handicap of meaningless experience. Nature already has supplied me with knowledge and instinct far greater than any beast in the forest, and the value of experience is overrated, usually by old men who nod wisely and speak stupidly. Only principles endure, and these I now possess, for the laws that will lead me to greatness are contained in the words of these scrolls. No special knowledge is needed, no special experience, no Stanford degree. What you need are principles, because principles endure. So let us study them together. And the first principle is you know nothing. First principle is humility. And this was where the name of the book came from, and the first chapter from this clip I'm about to play of Jim Cramer. And for those of you unfamiliar with Jim Cramer, he's a television personality and an absolute genius when it comes to picking stocks. His knowledge is incredible. He always has an opinion. And this outburst I'm about to play, it's old, but it's entertaining. It took place as we were entering the chaos of the great financial crisis. So let me play this clip and have a good chuckle with you. They know nothing. Now, I think the world of Jim Cramer, and I love the entertainment value, but I have to disagree with him just a little bit because the Fed knew more than anyone else. They had an army of analysts. They had tons of data. They had knowledge. We can debate whether they drew the right insights from that knowledge, but they knew a lot. And so this really brings up the first point, which is that having data is not the same as having insights. Having data is not enough to succeed in the investment world. The second insight is that knowledge does not equal power. You've all heard the expression, it's drilled into us when we're young, knowledge is power, knowledge is power, knowledge is power. But I'm here to tell you knowledge is not power. Asymmetric knowledge, one-sided knowledge, that can be powerful. Knowing I have two aces in my hand and you don't have that knowledge, that's powerful. But knowledge that's common knowledge that everyone has is not valuable, and we fool ourselves in thinking that it is. Asymmetric knowledge in the stock market essentially means insider trading. In this country, that's illegal. And so asymmetric knowledge is not a source of power when it comes to trading stocks. And then finally, we have to realize that no one has all the knowledge. The market has the most knowledge, but individual participants only have a piece of knowledge, a little bit of knowledge, if you will. And there's another expression which on knowledge, which is true. A little bit of knowledge is a dangerous thing. It's true, and it's applicable to each of us as we try to trade against the broader market, which has more knowledge every time. So trying to out-knowledge the market is a fool's game, a fool who hasn't learned the first lesson of humility. I just love, as a boy, I loved Hogan's Heroes. Hopefully, many of you are old enough to remember this. And I'm going to play another clip because I just like playing clips. I know nothing Schultz, so you probably remember him. And I'm not suggesting that Sergeant Schultz be our role model. I'm not suggesting that we forget all the knowledge that we have, that we cover our eyes and plug our ears, but we don't ignore the data that we have. We do recognize the data that we have, but we don't make that the basis of our decision process. And we don't do it partly because when we talk about knowledge, there's two types of knowledge. There are two types of unknowns, I should say. There are the known unknowns. Oh, well, I can, if I work hard enough, I can eventually figure out the known unknowns. But the bigger problem is the unknown unknowns. I don't even know what question to ask about that company. Something's going to hit it out of the blue. There's something that I don't even know enough to investigate. And those problems you can never overcome. So unknown unknowns, you're not going to overcome them. Okay, so let's take a poll. Who is the better investor? Jim Cramer, Sergeant Schultz. I got to play that clip one more time. Or a monkey throwing darts. And a monkey throwing darts might need some explanation. That essentially means random chance, right? Put darts in a monkey's hand and have him throw it at tickers and at a whole complete list of tickers in the stock market. So I'll give you a moment to enter your answers. And I will say that Cramer is probably an above average money manager, but you may not be aware of this. Do you know that the average money manager underperforms the market? We'll talk more about some of the reasons why this is, but they have historically underperformed versus the monkey throwing darts, essentially. And part of the reason why the monkey does so well is because the odds of a random throw hitting a small company are disproportionately large, and small companies have historically done well. So the monkeys actually do better than the money managers. I'll leave it up to you to decide if Jim Cramer can overcome that difference. And then in terms of Sergeant Schultz, I'm not aware of any studies about military men who value ignorance. But even if Schultz picked stocks randomly, I suspect that emotion, which we'll talk more about later, would play a role in his sell decisions. And so he would probably sell poorly. My vote in this poll would be a monkey throwing darts. Oh, sorry. Okay. Principle number 2, buy low, sell high. How's that for a blinding flash of the obvious? But this is so much harder than it sounds. First, let's take a look at the buy decisions. What does buying low mean in terms of what stocks you're going to be taking a look at? You're going to look at stocks near their 52-week lows. So terrible looking charts, down, 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 down. You're going to be looking at stocks in out of favor sectors that are boring. These are going to be companies which many people think might fail. So these are companies with negative news coming out about the companies. And they're companies you don't want to admit owning. When your friend says, hey, what's a good investment? You don't volunteer and say, oh, I invest in XYZ company that everyone hates. They might even be at risk of bankruptcy. They definitely have bad stories attached to them. Well, they could have bad stories attached to them. And they're usually value stocks, which are not as sexy as growth stocks. If they're exciting for all the wrong reasons. So buy low. Why would I ever want, basically you're saying buy a loser. Why would I ever want to buy a loser? And regarding selling high, we'll talk more about this throughout the presentation because the sell decision is always difficult. But what I will say for now is that if a stock has done really well for you, you start to value that stock. Some people have the tendency of doubling up on that stock, which we'll talk about. But it's like you have a new friend. It's easy to say goodbye to a company that has lost you money. Good riddance. Get out of my portfolio. But parting with a friend is much more difficult to do. It's like breaking up. And you always run the risk after the breakup of having seller's remorse. You're going to watch that stock. If it's been going higher and higher, and you're risking seller's remorse, you watch it go higher and higher. Ones that I think you should consider when it comes to selling high is to sell half of your position and lock in some profits and you can define what that looks like, what your trigger is, but selling half when you're starting to question whether you should be selling is never a terrible strategy. Now let's look buy low, sell high from the professional's perspective. Remember, your job depends on client perception of your skills. And what's the easiest way to damage that reputation? Question. How about recommending dogs, which everyone knows are losers? They won't do it. So they almost never recommend these dogs. Instead, they recommend stocks that have gone up, that are high, in the hope that they'll go higher. So let's take a look at two examples here. And I recognize this is pretty small print. The bottom one is Boise Cascade, value company, boring, with a downward graph. Now, I'm recommending Boise Cascade. I'm not recommending this other one, which is Apple. I'm just using these two as examples. So sell would suggest buying a company that has gone down. Apple, company that has gone up, 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 that's a lot easier to recommend. Sexy story attached to it. And if past is prologue, it's got a bright future. So the tendency of professionals is not to suggest buying low, but slow, and not to suggest selling high, but buying high and hoping for higher. And that's what we look at on this next graph, buying high and hoping for higher. So let's go back in time, 25 or 30 years ago. What was the Apple equivalent then? Let's do a little mental experiment. Which company had been going up, was in the right industry, and would not get you fired or damage your reputation if you recommended them? Well, there was actually a saying developed in the 80s which tells us who that company was. My father worked for them for over 25 years. Quote, no one ever got fired for buying IBM. And so here we have a graph of IBM. Now, that buying IBM, I believe they were about the equipment, but I suspect a similar mentality existed regarding the stock. And what happened to that stock? Over 25 years, from 99 to 2024, essentially no change. Flat for 25 years, while the rest of the market went up 500%. I don't think Apple's a bad buy today, but that this is the risk that you incur when you buy high and hoping for higher, because it feels good and it's easy. And speaking of things, let's talk about principle number 3. Passion is poison. I could get into a lot more detail here. Cognitive biases and emotional biases, but we don't have time to go into a lot of detail here. Suffice it to say that we as humans are messed up. Good decisions when our future prosperity is on the line. The emotions depicted in this chart start with optimism. They grow into excitement and euphoria. You've probably been here yourself when you've had a stock that's done extremely well. And then things start heading south, anxiety. Most investors underperform the market. It's not just money managers. Can any of you relate to this illustration? Share a story in the chat box if you'd like. The challenge for us mortals is to put off are fearful. Most are incapable of doing this, which is why so many turn to professional advisors for help. It's not that professional help is completely immune to this, but in theory, they should do better because it's not their money. So they may not fall into as many emotional traps, but they will fall into these traps, and they will fall into cognitive traps as well, which you'll have to go to the book to get more detail on what traps might. But to summarize, traps are ways that we lie to ourselves in order to hold on to a stock or buy a stock. Principle number 4, have clear metrics. Now, this is perhaps the most critical rule out of the 10 and the most difficult. But first, why is it critical? Because, again, we're human, subject to all the biases we just talked about and biases we didn't talk about. But as emotional and imperfectly thinking creatures, we will talk ourselves into the wrong decision almost every time. We are flawed. We know nothing. And therefore, our decisions will be flawed. We need an anchor rooted in logic and value to help keep us honest. Without that anchor, how will we make our buy and sell decisions? How do you determine what is low and what is? Who do you turn to? And unfortunately, oftentimes we turn to some of these more common things, and the bottom line is these common sources, and the bottom line is they don't know either. They're just guessing. Some of them guess very confidently, but they're still guessing. Using metrics, we may have success if it's a good metric and allows us to compare value between companies, because what we often forget in buying stock is we're really buying a small piece of a company. And if you're going to buy a company, just like if you're going to buy anything, what you're looking for is value for money. As Warren Buffett said, price is what you pay, value is what you get. Whether you're talking about socks or stocks, I like buying quality merchandise when it's marked down. So you're looking for a metric to help you identify those markdowns. Before we talk about specific metrics, I have to say a word about price, because sometimes people think that price is a metric, the price of the stock. And it absolutely is not. It has no bearing. It has no relevance. Whether you're talking about a $5 stock or a $3,000 stock, that says nothing about the value that you're getting for that stock. It says something about the number of shares outstanding, perhaps, but nothing meaningful in our world. So which metrics should you rely on? There are lots of metrics that you should not rely on, and unfortunately, they're the more common ones. These are poor metrics. PE ratio, or price to earnings, dividend yield. This is a cyclically adjusted PE, which is better than PE, but all of these metrics suffer from the same problem. They will undervalue growth companies. And that's great if we're in a market where only the value companies are the ones making money. We have not been in that market for many, many, many years. You do not want a metric that eliminates all growth companies. So a better option is to find a metric which incorporates growth somehow, or at least levels the playing field. The PEG ratio is price divided by earnings divided by the growth rate in income. So if you have a high growth company where income is growing quickly, it should, in theory, allow an apples to apples comparison with your more traditional value companies. Better than the PEG would be a cyclically adjusted PEG, right? So the PE ratio goes up and down with the economy for cyclical companies. You want to try to get past that. Another option is using poor metrics. Laser pointer back on. Some of these poor metrics, but only using them versus how that company has performed in the past. So what's the PE today versus the average PE? Maybe that's a bad example. What's the dividend yield versus the average dividend yield over the prior 5 or 10 years? That's a better metric and gets around this growth versus value problem as well. The best metric is not available to you directly, although you can always develop one yourself. I use proprietary metrics, making sure I always adjust for the business cycle and always adjust for growth in growth companies. I'm more than happy to share the rankings that come out of my metrics. This again, happy to pick up the phone and talk about how your specific companies are evaluated with my system. Feel free to book one-on-one time if that's of interest to you. So what metric do I use? The proprietary in-house regressions are my thing. So regression models may be unfamiliar to most of you. A regression model is a statistical model that estimates the relationship between one variable, one dependent variable, I should say, which is the result, and multiple independent variables, the inputs. It's used to predict outcomes like price performance of a stock and understand the influence of various factors or various inputs. So here's a hypothetical example. Let's say that we wanted to predict test scores of students before they actually take the exam. Well, hypothetical inputs might be the number of hours they study for the exam, IQ, hours slept the night before, etc. And then you have to work some mathematical magic. You put that into a formula, and the predicted score equals a constant times study hours plus another constant times IQ, et cetera, et cetera. And I want to point out at the end of this, I know this is a little bit complicated. I don't want to spend too much time here, but there's an error term. These are just predictions, right? So we might have a value model that predicts what value a company, what stock price a stock should trade at. There's going to be an error term there. And the more complicated the system that we are regressing, the bigger that error term. And things can get very complicated in a hurry. I don't want to dwell on this, but you could easily have a dozen, 15 inputs to describe one output. And so this is what I end up doing on behalf of clients for my It's what I did in a former life with AutoZone. I would predict same-store sales. I had a couple of teams of data scientists that worked for me, and they would develop regression models to predict the impact of weather on same-store sales or competition or gasoline pricing, et cetera. I do the same thing in the stock market, but it's very complicated. I end up starting with hundreds of data points for every stock, for thousands of stocks. So hundreds of data points, thousands of stocks, hundreds of thousands of total data points. I do regression analysis, and I come up with equations like that equation for the student testing. I do that, and then I do it multiple times. I have a regression model for stocks go down. I have a regression model for when stocks seem to be going up, often driven by growth companies. I have a model that predicts stock prices based on interest rates. I have a model that predicts it based on valuation. And so what I do is I combine all of these models. I don't want to spend too much more time on this because it's hard for you. You can't easily replicate this at home. But I then try to identify a subset of stocks which can survive regardless of what the market throws at us. So if the market goes down, I'm looking for stocks that will do well in that environment. If the market goes up, I want stocks that will do well in that environment. And I'm finding what I call robust stocks. And I assign a score to every one of my 3,000 plus stocks on how robust it is. And before, I'll get back to the rules for a second. I just want to point out that this process has yielded good results. This graph looks at all of the down months in the market since the beginning of 2022. So if 1 month is down and 1 month is up, I'm only looking at the down months. And in those months when the market was down, it was down an average of 4.3% per month. My equity clients were down less than 1%. And we haven't really talked about options, but my options have outsized potential to do well in a down market, and they were up an amazing 16% per month. But let's get back to the. We can talk more about that one-on-one if you're interested. Let's get back to the 10 rules. I think we've got about 20 minutes left in this discussion. So principle number 5 is the trend is your friend. Knowing when to get into a position, knowing when to get out of a position, those are always tricky things. In business school, they will teach you that stocks follow a random walk through time. And looking at graphs is useless. I have to confess, I know of very few students who actually believe their professors on that one. Stocks tend to move in channels, as you can see with this one example. They encounter resistance on the upside and support on the downside. And you can probably learn through a quick Google study how to draw basic support and resistance lines on a stock. Understanding those signals is important to understanding when you should buy and sell your chosen stock. So this doesn't drive what stock you're buying, but it does. It can drive when you get into that stock. So draw a buy after it breaks some resistance, sell. After it breaks some resistance, and sell it when it breaks through support. But again, the metric should be your key to buying and selling. This is secondary, but also important. Pigs get slaughtered. Principle number 6. Common expression in the investment world: bulls make money, bears make money, pigs get slaughtered. Well, what does it mean to be a pig? It means you got too greedy. And there are several ways to become a pig in the market. I mentioned earlier doubling up on winners. It's a natural tendency and it's wrong. If my stock has doubled already, I'm not going to double it again. bringing me to 4 times my initial investment. We're going to talk about diversification, but no, this is not something you want to do, and it's the opposite of buying low, right? You're buying high because the stock has already gone up significantly. Holding on to a stock for too long also can be piggish. Wow, I love how much money this stock has made for me. Again, it goes back to our earlier discussion. And finally, leverage, which we'll talk about in chapter 9. Leverage is dangerous, and that's all I will say at this point, I guess. We'll talk more about it in section 9, but leverage on a single stock without diversification is beyond high risk, so we definitely don't want to do it. So what do we do to overcome our pig-like tendencies? Implement fixed selling rules. I do this all the time with my option trades, but you can do it with stock trades as well. Sell a third when the stock has gone up 33%, and the second third is plus 67%, and cash out at 100%. Is that going to cap your upside? Yeah. There's sometimes you hold on to a stock and it could gain 200, 300% or more. But if you find yourself with piggish tendencies, better to have fixed rules to contain them than to ride the stock up and ride it back down again. Do doubling down. I like this rule a lot. I've used it a lot. And so I'm going to walk you through an example here of how this works. Now, again, like the other stocks, I'm not recommending Intel, but I think Intel has been one of the larger, well-known companies that has been a real poor performer over the last 5 years. And I'm going to show you that even with a poor performer, you could make money by doubling down. So in this hypothetical example, let's say that the investor bought 100 shares at $45 a share roughly 5 years ago. They then enjoyed a nice ride up to about $68 a share. So that was a pretty healthy gain, but they didn't cash out because they're a true believer in Intel. And then the stock started falling, and they're pretty unhappy at this point. They're negative and it keeps on going down. Well, at some point when things have leveled out, they say, okay, I'm still a believer. I'm going to buy 180 share. I'm going to double my investment. And now it's at $25 a share, so they can buy a lot more shares with that doubling of the investment. So now they buy 180 shares at that lower price. And again, they're happy. It goes up, not as high as last time, but still up. And they say, this is great. But of course, they don't sell. And it goes down, down, down some more, and then again, levels out. So they buy again. Now, they may not double at this point because they're a little nervous at how the entire market is telling them they're wrong. But they do the same as their initial investment. And that gives them 225 more shares. And bottom line now, with the doubling down process, with doubling down twice, their total investment is earned 35% return given today's valuations. If they just stuck with the one and didn't do anything and held on for 5 years, they'd be down 18%, while the rest of the market's up significantly. So this just highlights how even with a terrible stock like Intel, you would have still made 35% return by doubling down and following some rules. One caveat: only double down on companies with very low risk of bankruptcy. Bad stories are fine, but if there's a high probability of bankruptcy, then this is a very dangerous process. Okay, principle number 8, stay diversified. Why is diversification important? Or said differently, why does the financial industry push diversification so much? And for those of you who use professionals to manage your money, the answer may shock you, because in most cases, as I alluded to earlier, they have no idea what makes for a good versus bad investment. So diversification protects them. It protects their reputation. If all you're looking for is a diverse portfolio, then you shouldn't have a money manager. fire your manager, buy an index fund. You'd be better off. But principle number 8 is not telling you to not stay diversified. We need to understand why we should stay diversified. It's not for our money manager's protection. We're going to walk around this circle, okay? And it starts with rule number 1, I know nothing. And because you know nothing, you will make mistakes. Some of your stocks will be good picks, some of them will be bad picks. Also, the market is going to stumble from time to time, completely out of your control. Things are going to go down. And if you're not diversified, if you're in, to draw an extreme, one stock, one mistake could kill you. And it's really hard to come back from a huge decline. If a stock goes down 50%, it needs to go up 100% to break even, right? So one mistake should not kill you. You always need something to sell. So when that market goes down, or when some of your individual stocks go down, some of them hopefully will go up. You always need to have something that has gone up that you can sell, turn around, redeploy that cash, and try again. Invest it in some additional stocks. Invest it in some of your losers, perhaps, by doubling. Maintain your humility and continue investing in this cycle. This is kind of a form of rebalancing. But I have to say, when it comes to diversification, if you never do this learning and redeploying, then you should not diversify. The benefits of diversification come from the rebalancing process, the investing when some asset is low. Without that reinvestment of funds, diversification has no value. Okay, principle number 9, avoiding weapons of mass financial destruction. That's another way of saying options. Is investing in options just too risky? And the answer is maybe. It kind of depends on how you invest in options. And I've had a bit of a change in heart since writing the book. In the book, I say, and I think this is still true for most investors, I say absolutely avoid options. I don't say that today because, well, let's look at this. If you're over here, the answer is still yes, too risky, avoid it. Do not do single option contracts because someone told you this is a great stock and you want to hit a home run. That's the wrong way of using options, and that is absolutely too risky. With options, you have to be right in 3 things at once. You have to be right in the direction the stock is going to take, the magnitude of that direction, and how long it's going to take to see the move. And being right in all 3 is very difficult to do. So think of an option contract like going to the roulette wheel and betting on black, except your odds are a lot lower than 50-50 on having the payout. Now, things become more interesting if you consolidate, if you diversify across a large number of option positions. So in that world, some are going to be winners, some are going to be losers. And going back to the previous slide, it's that virtuous wheel. You can actually reinvest winners and losers. And well, maybe that's not said quite the right way, but a portfolio of option contracts has the potential for significant payout at a lower risk. Still large risk. The month-to-month volatility on a portfolio like this is very large, 30% plus per month. So this is still not recommended for the lion's share of investors. However, and this is the point I want to make to you, as I know we're running low on time, combining a mostly equities portfolio with a well-diversified option portfolio, but in a minority position, can be quite beneficial. We've seen this with our clients. I got a poll you can answer quickly. How much risk do you find appropriate? For most of you, it should be either mostly equities or all equities, but I'll let you answer that. I do want to share with you the results from Our clients doing an 80-20 mix of equity and options. So this is 80% equity and 20% option, diversified option portfolio. And you can see over the last few years, that mix of equity and options would have outperformed the a straight equity portfolio by 13% a year. That doesn't mean there isn't volatility from month to month. Doesn't mean you don't have any negative months. We had one bad month in February, down 8%. But these bad months are not going to be happening the same time as the S&P is down significantly. The S&P was down 6% in March. That was a positive month because the options tend to pay out when the overall market goes down. So enough said on that. This is the summary of the entire book. We've talked about 9 other principles. They can be summed up with principle number 10, which is be opposite George. I don't know how many of you are familiar with Seinfeld and the opposite George episode. Let me just play this for you. Okay, I just love that clip. But in all fairness, life does not always play out like a comedy sketch, and beautiful women are not always attracted to the truth. Even so, the principle is correct. As Jerry Seinfeld says, if every instinct you have is wrong, then the opposite would have to be right. Oops, sorry. So, in summary, when you think you figured it out, you haven't. When you want to avoid a stock because it's dropped, buy it instead. When your numbers say buy, then buy it. When you want to act, wait until the trend changes. When a stock is up significantly, sell it. Don't buy more. When you want to sell a beaten down stock, buy more. Oh, there you go. Sorry. When a few stocks are driving performance, sell to diversify. When you've decided you're good enough to leverage, relearn humility, or hire a professional. In other words, be opposite George. So doing the opposite is not easy, and it's okay to admit that. If any of you decide you want someone else to manage your assets, I would be honored to do so. Here's a small snapshot of how that works. Client opens up a brokerage account with Schwab. Your relationship is with Schwab. Your money is directly with Schwab. They send you your statements, your tax tax forms at the end of the year, etc. You can log on to Schwab at any time, see exactly what's happening with your account. You fund the account. You grant me permission to make trades in your account, trades only, which is this one. And then we decide if your account should include some options. And then I make the buy-sell decisions on your behalf. So that's how that works. I normally I deal with $1 million plus accounts, but I do test at lower levels of $100,000. And our results have been phenomenal in good times and bad. This year, we're on track for 50% return in equity accounts, 100% plus in option accounts. And even in bad years, when the market was down 20% in 2022, we only saw a 4% decline. So great results in good times and bad. book a one-on-one call with us, and we'd love to spend time talking about your needs, whether it's for us to manage your money or to clarify any of these other principles. Please book an appointment today. It's easy. There's a little pop-up that appears on your screen, and it'll take you to this website. Pick a day, pick a time, and we can have a 30-minute chat. I would be honored. And as I mentioned earlier, first 10 to do this will get a free copy of my book. And a second incentive is a free risk analysis of your existing portfolio. So I can take my modeling, I can tell you, I can project with your existing holdings what would happen if the market went down X%. So we can look at that stock by stock, 30 minutes, the time is yours. Please, I encourage you to use it as you would. We don't have a lot of time for questions and answers. I see we're at about 1 minute and a half left. I'll pick just a couple of questions here. Let's see. Asking about metrics. How do you do regression models at home? In theory, it's possible. Excel does have a basic module, but without training, it'd be easy to make mistakes, and I would not recommend it. Another asks about selling call options instead of buying them. So I typically buy call options. I buy put options. I always maintain both for clients so that they're covered if the market goes up, they're covered if the market goes down. I shouldn't say covered. They make money if the market goes up. They make money if the market goes down. But many people will end up owning a stock position and try to get a little bit of extra money by selling the call. They get paid a small amount, and that works great as long as your stock doesn't go up. But if you're good at picking stocks, then that's a bad strategy, and your best winners get pulled away from you. So I would recommend that if you don't know what you're doing. If you do know what you're doing, I would not recommend it. And last question, where can I get individual stock data without copying and pasting one data point at a time? So AAII, American Association of Individual Investors, they sell data packages at a reasonable price. I would recommend going there. You might pay a few $100s per year, but it's great for the home gamer. Tons and tons of data on every stock. So that is it for our webinar. We've exceeded our hour now. Thank you so much for your time and your attention. I look forward to meeting with each of you one-on-one, where I can provide advice for how you can apply these on your own or through me. Either way is great. I wish you investing success and appreciate your time. Thank you so much.